Hi, I'm Josh Gladwin from Humphreys Co Solicitors, and I will be giving you a presentation today on stamp duty land tax, or SDLT, and how that affects you as a first-time buyer of residential property. So what is stamp duty land tax? Stamp duty land tax is a tax charged on the legal instruments, so for our purposes, the lease or the transfer deed that transfers the property into your name. Now, historically, stamp duty was charged on various paper items, from playing cards through to newspapers and even dice stamped on their packaging. It was such a successful tax that it was then taxed on various other items such as patent medicines, gold and silver plate, perfumes and cosmetics, and so on. Stamp duty was largely replaced by stamp duty land tax, SDLT, in 2003. It's a transfer tax derived from stamp duty, meaning that it is only payable when legal title passes from one person to another. For example, the transfer from the seller to the buyer. So why does this matter to you? As the purchaser of residential property, you may need to pay stamp duty land tax when you purchase property. You must always file an SDLT return, even a nil return, unless you're staircasing to a percentage up to and including 80%, provided that the purchase price is above £40,000. I say this because £40,000 is the chargeable consideration, upon which you only have to file a return if it's above 40,000. SDLT rates have varied historically and were until the 8th of July as follows. If you bought a freehold property for £125,000, you paid no SDLT. If you bought a freehold property for £250,000, you paid 2% on the chunk of 125 to 250. So the SDLT you'd pay if you bought a property for £250,000 is £2,500. And you see from the graph on the screen that this is the cake slice method. So as you stack up, you pay increments of increasing SDLT. It seems simple enough as per this graph, but SDLT rates between the 8th of July and the 31st of March 2021 have changed. The Chancellor Rishi Sunak announced in response to coronavirus that the SDLT on purchase prices up to £500,000 is abolished, at least until the 31st of March 2021. So the cake slice method continues once you go above 500,000. You see from the graph that you pay 5% if you go above 500,000. You pay that on the slice only. You don't pay it on the 500,000 of the first 500,000. You only pay it on the slice of 425 up to the 925 as per the graph. In the previous scenario of a £250,000 purchase, you now pay no SDLT as it's below the £500,000 threshold, and those are the rules currently. However, leasehold properties are different. Shared ownership properties as well are leasehold. A leasehold property is where you, as the leaseholder, own a lease typically for 125 years or so, and the landlord retains the freehold. When the lease runs out, the lease goes back to the landlord, but that usually doesn't happen because people do a lease extension and extend the term of their lease, and that's typically the way it's done. So why does it matter that the property is leasehold? Because SDLT is calculated differently on leasehold. You pay SDLT on the premium to the purchase price, as you would with a freehold, but you also pay SDLT on the rent. Unless, of course, it's a resale property, in which case you would use the normal freehold formula, which we discussed earlier. Let's say that you purchase a share in a property for £250,000. However, this time it's an 125-year lease. You pay £5,000 a year rent. The SDLT would be zero. You pay 1% SDLT on the rent of the chunk of the net present value above 500,000, which is still zero because of the recent abolition of SDLT below 500,000. You see from the graph that the net present value doesn't reach 500,000, so there's no SDLT to pay there. So the key takeaway with leasehold is that you pay it on the premium, the purchase price, and you pay it on the rent, but only if they go above £500,000. Now, with shared ownership new build properties, you have two options as to how you're going to pay SDLT. One, you pay on the share you're buying now, the 25, the 40, the 50, whichever percentage you're buying, or you pay on the full market value, the 100%. Now, note, you cannot do this with resales. You have to pay on the share that you buy at the time of your purchase. You can then staircase, but you can't make a full market value election. So let's say you're buying a 50% share in a property for £375,000 and the full market value is £750,000. So the full market value is above the £500,000 threshold by a good margin. let's say for purposes of argument, it's £5,000 rent again. The premium is below 500,000, so there's no SDLT to pay there. And even with the rent factored in, there's no SDLT to pay on the rent. If the rent increases the net present value to above 500,000, that means you pay 1% SDLT on the chunk above 500,000, which you can now see is quite hard to do, even on a property where you're paying £375,000 in the premium, and you're paying a good rent of £5,000 a year. The net present value is still very low. It's below 500,000. And so you can see it's very hard to end up paying SDLT on a property at that price, with the threshold being 500 as opposed to £125,000. So if you're going to make a full market value election, the formula is the same, i.e. you elect to pay on the 750,000 as opposed to 375, but the principle is the same. You'll see here that on the above 500 to 925,000, you pay SDLT on a percentage of 5%, which is £12,500. But the rent is low and it hasn't pushed the net present value above 500,000, so there's no SDLT to pay there. If it had, if you paid a high rent, let's say, and it did push the rent above 500, the net present value above 500,000, you'd pay SDLT on the 1% above 500,000. So the main figure you have to remember here is the 500,000. When you staircase above 80% ownership of a shared ownership property, you have to pay SDLT on the share that took you over 80% and any transactions after that. If the property's value increases substantially, you could find yourself paying more and more SDLT later if you didn't make a full market value election at the outset, especially if you staircase from 100,000 in one go from 25%. Once you make a full market value election, however, you don't pay any more SDLT on the property once you staircase, regardless of its value. It could shoot up to £1,500,000 and you could staircase and you would pay no further SDLT because you've already done so. You've been deemed to have done so at the outset with your full market value election. So you could find yourself making a big saving if you take advantage of the £500,000 raised threshold. So those who are not familiar with property transactions, a lot of this may be quite confusing, and it can be quite surprising and unwelcome news that you'd have to pay tax on a property purchase. But given how much you have to save, even just for the deposit when buying your first home, having to hand over a few £1,000s to the government seems excessive. So everyone here will appreciate that buying a property in London is very expensive, and that's partly the justification for shared ownership and other schemes like it, like Help to Buy and so on. With shared ownership properties, as you're all aware, you purchase a percentage and the housing association holds on to the remainder. With shared ownership properties, you pay SDLT on the share that you purchase, and unless the property is a new build, in which case you have the option to pay SDLT on the 100% value if you want to. If you're intending on living at the property for a long time and staircasing in the future, it may be sensible to pay SDLT on the 100% and save money down the line. If you can afford to pay SDLT on the 100% election, you could save a lot more SDLT when you staircase due to the revised thresholds. Now, you'll be wondering, do you need to work these figures out for yourself? Do you need to do the sums? When you instruct Humphreys Co, we ask a few details about the property by email. Once you get back to us, we provide a same-day, no obligation, fully costed, no move, no fee quotation with a complete and accurate calculation of SDLT on the basis of the information that you provide. Now, we also calculate the SDLT again before exchange and again before completion, and it remains provisional right up until the point of completion of the SDLT return. And we have to emphasize that the SDLT rules, for example, have changed very recently, the 8th of July, so not even a month ago, and so they always remain provisional right up until the point that we've completed and submitted the return on your behalf. But we provide the figures to you at the outset, so you have a full understanding of what you're likely to pay and whether it's worthwhile making a full market value election. But I should just say that it remains provisional, but you have full information at the outset. So if you have any questions, feel free to jump into the live stream that's going on the Humphreys Co booth from 10 till 4 today, and we hope to hear from you. Thank you.